Imagine it's the morning of a massive stock market crash. The screens are red, the news is panicking, and everyone is losing their minds. Let's look at three different people. First, there's Lloyd. Lloyd is sitting in a grocery store parking lot, his cold brew sweating in the cup holder, refreshing his brokerage app for the 11th time. At exactly 10:22 a.m., he panics and sells everything. He knows the exact minute because he took a screenshot of it. Then there's Nadia. She's at her desk at work. Her phone buzzes with breaking news alerts about the market crashing, and she swipes them away like annoying mosquitoes. Why? Because 7 months earlier, she wrote one sentence on an index card and taped it inside her desk drawer. Finally, there's Gwen. Gwen has $300 million. Her family office called her that morning. The call lasted exactly 4 minutes. Nobody sold a single thing. Spoiler alert, by the middle of the next month, the market had recovered almost every point it lost. 2 of those 3 people came out ahead, and none of them, not even the billionaires with expensive advisors, saw the crash coming. And today, we're going to dismantle the most expensive myth in personal finance: your quiet suspicion that rich people get a secret warning before the market tanks. They don't. Nobody does. What the ultra-wealthy have instead is boring, mechanical, and mostly free. And by the end of this video, you are going to be able to copy exactly what they do. If you've ever watched your portfolio bleed and felt like there was a secret club you weren't invited to, hit subscribe. We're walking into that room right now. What the smart money actually does. First, if you've ever panic sold and watched the market bounce back 2 weeks later, take a deep breath. You aren't an idiot. In fact, you behaved exactly like human hardware is wired to behave. But let's look at what the actual data says about the ultra-wealthy. Every year, UBS surveys single-family offices. These are the private investment firms set up for individual ultra-wealthy families. The average net worth in their latest report, $2.7 billion. If anyone is getting a secret warning, it's them. They can hire former Treasury officials just to tell them what to do on a Tuesday. But what do they actually do with all that insight? While everyday investors were reading headlines and moving to cash, 59% of these billionaires ran the exact same portfolio risk as the year before. Only 35% expected to change anything. They described their strategy with the least exciting phrase in finance: all weather. $2.7 billion, and their master plan was simply to sit there. Now, you might be thinking, but wealthy people invest differently. And you're right, but not in the way you think. The wealthy aren't investors in the way you and I use the word. They are owners. The top 1% of American households hold roughly 53% of all private business equity in the country. Not stocks you can trade on an app, private companies. There is no ticker symbol. There is no price updating every 11 seconds. And most importantly, there is no way to sell those businesses in a panic from a grocery store parking lot at 11:22 a.m. For the average person, your biggest asset is the place you sleep. Your portfolio can be liquidated during a commercial break. But for the ultra-wealthy, nearly half their wealth sits in things with no continuous price and no exit button. Wall Street tells you that private equity holds up better in a crash. On paper, it does. But the half they leave out is that private assets are valued by appraisal, not by live auction. It's not that the storm was gentler over there. It's just that nobody sent them a photo of their damaged roof. Illiquidity isn't a flaw in a billionaire's portfolio. It's a safety mechanism. They are protected from their own worst instincts by mountains of paperwork. You are not. You have a sell button, and it is always 11 inches from your face. The market timing trap. Which brings us back to Lloyd, our friendly, panicked friend in the parking lot. Let's do his math honestly. You've probably heard the classic statistic. If you leave $10,000 alone in the S&P 500 for 20 years, you make a killing. But if you miss just the 10 best days, your returns get cut in half. But here's the part nobody includes, and leaving it out is basically lying to you. If you somehow magically missed the 10 worst days, you would have beaten the market by a wide margin. The mathematical impact is almost identical. So the real truth isn't that timing the market is mathematically impossible. The truth is that to time the market, you have to be right twice. You have to know when to get out and exactly when to get back in. And here's the kicker. The best days and the worst days are neighbors. The median gap between one of the 10 worst days in the market and one of the 10 best days is just 7 days. 7. The market's greatest single-day rallies aren't happening on calm, sunny afternoons. They happen exactly when your hands are shaking the most. To catch a massive rally, you have to buy on the day the news is at its absolute worst. You have to buy when every survival instinct in your body is screaming at you to run. Lloyd sold on March 30th. It turned out March 30th was the absolute bottom. He didn't just miss the bottom, he personally attended it. Even professionals fall into this trap. In 2007, Warren Buffett famously bet $1 million that a plain, boring S&P 500 index fund would beat a basket of highly paid hedge funds over a decade. Over 10 years, the index fund returned 126%. The hedge funds? Barely 36%. But sit with a twist inside that story. Those hedge funds actually won in 2008. When the market crashed 37%, the hedge funds only fell 24%. They did their job perfectly in the exact year everyone was terrified. And then they spent the next 9 years giving those gains back. When you buy protection in the market, it is never free. You pay for it in every single year that isn't a crash. And there are way more good years than there are crashes. The billionaire playbook you can copy today. So, if the wealthy aren't predicting crashes and they aren't hoarding cash, what was exactly happening on that 4-minute phone call Gwynn took? Nobody made a decision that morning. They simply executed decisions that had already been made. And this is the one thing in this entire video you can copy for free right now before you even finish your coffee. Wealthy portfolios do not have a better crystal ball. They have a written instruction set. A downturn is just the trigger. Let's build yours right now. Here are 4 things the wealthy do during a crash. 3 you can do this week, and I'll be totally honest with you about the 4th. Number 1. Rebalance on written bands, not on feelings. You decide in advance that if your stock allocation drops more than, say, 5 percentage points from your target, you automatically sell what's up and buy what's down. No meetings, no opinions. You just do the math. During the March 2020 crash, Vanguard studied over 5 million households. 83% of everyday investors made no trades at all. 9% actively rebalanced into the decline. The story about retail investors constantly panicking is mostly fiction. Nadia, with her index card, held her ground. Lloyd, who reads 3 financial newsletters and thinks he's a genius, panicked. Number 2. Harvest your losses. To the wealthy, a downturn is just inventory. When stocks drop, you sell your losing positions, instantly buy something similar but not perfectly identical, and bank the paper loss. You can use those losses to offset your taxes indefinitely. By panicking and going to cash, Lloyd realized gains he didn't want and locked in a loss he couldn't use. He essentially found a way to lose twice in a single transaction. Loss harvesting is a gift the market hands you during a crash. Take it. Number 3. Convert when prices are down. If you've been meaning to move money from a traditional retirement account to a Roth account, a market crash is the perfect time.
Your tax bill gets calculated on the depressed, smaller number. But when the market recovers, and it always does, that entirely new growth lands in an account where it will never be taxed again. Nadia did this from her couch in about 9 minutes. Number 4. Move assets. The wealthy secret. And number 4, this is the one you probably can't use, but I want to show you anyway so you know how the game is played. When asset valuations are deeply suppressed, ultra-wealthy families move assets out of their estates and into trusts. Because the asset's value is temporarily low, it doesn't trigger massive gift or estate taxes. Then the entire massive recovery happens legally in someone else's name, like their heirs. If figuring out how to hide your 30th million from the IRS is your Tuesday problem, congratulations. That's Gwen's world, not yours.
But steal the logic. The logic is totally free. A downturn is the absolute cheapest moment to move an asset from where it is to where you permanently want it to be. For Gwen, that's a trust fund. For you, it's a Roth IRA or a long-term brokerage account. Fire yourself. Let me leave you with this. If you're sitting there right now, stressed about the market, wondering if the responsible thing to do was to pull your money out until things calm down, you aren't being stupid. You are being a normal human being. The urge to sell during a market decline isn't a character flaw. It is a biological threat response. You are running on hardware built to run away from apex predators, but you're applying it to a shiny app that updates your net worth every 11 seconds. The stakes are completely warped. If you are still working and investing, a market crash is a discount. You should want it. The financial system fails you because it hands you a live feed of your life savings and puts a one-tap sell button right next to it, and then acts shocked when you press it. Gwen's protection is that her assets are legally difficult to sell, and her decisions were calmly made in a conference room in January. Yours has to be built on purpose. So do this tonight. Take 15 minutes and write one single sentence. Write exactly what you would do if your account drops 20%. Set your rebalancing rules. Automate it so you don't have to feel anything on the day it happens, and decide right now how long you will go without checking your phone. Gwen wasn't consulted on March 30th because the January version of Gwen did not trust the March version of Gwen. She fired herself from the job of reacting. You need to fire yourself too. The market will not reward you for seeing a crash coming, but it will heavily reward you for having already written down what you were going to do back when it felt unnecessary. The best time to write that sentence was last January. The second best time is tonight. If you found this helpful, hit the like button, subscribe to the channel, and let me know in the comments what your one sentence is going to say. See you in the next one.